Okay. Good afternoon, everyone. Thank you for sparing the time today and joining us. We're excited to shed some light on a mega financial event that is the transition from LIBOR and its possible local implications. This event was accurately described by the LIBOR to SOFR working group, as I quote, an unprecedented global financial engineering project of massive scale that will require extraordinary coordination, cooperation across institutions, markets, and jurisdictions, unquote. So myself, Faisal Al-Jasser from Ihata, I will be joined by an experienced risk and accounting consultant, Mr. Paco Carballo from Vedenta Hedging. We will try today to cover the relevant elements of this huge event and address some of the questions surrounding this transition. Allow me to provide you with a brief on Ihata and Vedenta. So Ihata Financial is regulated and licensed by the Capital Market Authority in Saudi Arabia. We are an independent financial risk management advisory firm specialized in market risk. We cover interest rate, foreign exchange, commodities, derivatives, and valuations, and hedge accounting. It's worth noting that Ihata is fully independent and is free from any restrictions that could affect our ability to recommend what is best for our clients. Vedenta Hedging is also an independent firm of experienced corporate treasury consultants, providing impartial advice on hedging and practical support to businesses operating in the UK and Europe for more than 10 years. So before we start, for you who have registered but weren't able to attend, this presentation will be recorded and shared post the webinar and can also be found later on Ihata social media channels. We aim to wrap up in 45 minutes, followed by 10 to 15 minutes of Q&A sessions. Please type your questions during or after the presentation. Your questions will not be visible to the rest of the audience. We will do our best to address your questions in this webinar, and if the time didn't allow us, we will address them after the webinar. This webinar also includes 2 poll questions with multiple choice answers, and we'll be looking forward to receiving your feedback. So I think let's go for the table of contents. So we will be covering the following topics today. So a bit of background on what's happening on the transition and LIBOR. We will also be talking and introducing SOFR. This is the main candidate to replace LIBOR. And then we will go into the practical stuff of the road to actual transition. And then we will also be shedding some light on the local market implications towards the end of the presentation. And then we will end up with the Q&A. So next slide. Okay, LIBOR remains by far the most important global benchmark interest rate underlying trillions of dollar contracts. It is estimated that this year, sometime in this year, US dollar exposure was around $223 trillion divided among different categories, derivatives, loans, bonds. To put this into perspective, this is around what, 2.55 multiples of global GDP in 2019. This is around 3.5 times of global consumption expenditure in 2019. This is 0.79 multiple of around of the record sovereign debt, recorded sovereign debt size in 2020. So it is a big and huge exposure, a big major event that is happening. So before we continue, I believe we have one poll question here. This question will help us understand how many of the audience is exposed to LIBOR. So please select the answer that describes your case. So can we see the question now? So do you have any US dollar based exposure? That is, i.e. exposed to LIBOR? We'll just give it 30 seconds before we get to see the results. So I guess we can have the results now. Okay. So we have around half that who does not have US dollar exposure, or they are not exposed to LIBOR. Somewhere around 15% has only loans that are exposed to US dollar. And we are talking about 26% that has loans and derivatives. That's somehow big. Even for audience who are not exposed to the LIBOR, this is very important because we will also be discussing the CYBOR. The CYBOR is very similar to the LIBOR. So this is, I guess, a trend that is happening right now that would affect a lot of reference rates globally, including the Saudi Riyal one. So this would be very useful for those as well of the part of the audience. So thank you very much for sharing with us your answers. So shall we go next? Okay, so it's important to know that LIBOR is published in 5 different currencies: Euro, Japanese yen, sterling, pound, Swiss franc, and US dollar, and for 7 different interest periods ranging from overnight to 12 months. So the sums of all of these exposure gets around what? Around $370 trillion. So if we add the other currencies, that even makes it a more of a mega transition when added with the other currencies. So the main objective of this massive project is what basically is to transition to a more reliable alternative rate. And the push is to transition to a risk-free rate. So why risk-free rates? So risk-free rates are based on real observable transaction data, which is more robust and stable. LIBOR, on the other hand, has an element of expert judgment. So, and further to that, also LIBOR include a credit spread, while risk-free rates normally they don't have. So that's why it will be likely that whatever rate will replace LIBOR will be lower than LIBOR. So why the transition? So basically, cases of misconduct and manipulation allegation involving banks' LIBOR submission has been the core basis of such a transition. In 2014, the Federal Reserve summoned the Alternative Reference Rate Committee, the ARRC, to identify a robust and credible market transaction-based rate. Several official bodies have steered that reform as well since then. And in July 2017, the UK Financial Conduct Authority announced that it would no longer compel reluctant banks to submit cost of funds codes to support the calculation of LIBOR post-2021. In the case, that's of course regarding all of the other currencies, but in the case of US dollar LIBOR, because we saw on the first slide how that is significant by alone, how significant that exposure is, that will be extended to June 2023, except for some less liquid periods. These will also be discontinued by end of this year, but I would say the major ones, the 1 month index, the 3 months index, and so those would be extended to June 2023. So next slide. So here we will be talking about SOFR a bit. So in June 2017, the Alternative Reference Rate Committee identified the secured overnight financing rate, which is SOFR, as its preferred replacement for USD LIBOR. Since then, SOFR had become the dominant candidate to replace LIBOR. The regulators prefer SOFR because it's less prone to market manipulation. It's purely transactional based, and we will talk more about how SOFR is actually being computed. So as I said, SOFR is the rate on a secured overnight loan. It measures the cost of borrowing cash overnight and is derived from a broad universe of actual overnight treasury repo transactions. So there are 3 treasury repo transactions that are overlooked by the US government, basically to make sure that these, and they are very much liquidity abundant and deep markets. And basically the computation is done by taking the median transaction weighted rate that are collected from these 3 major markets to come up with what the SOFR is. So what's the difference? The simple question comes, what is the difference between LIBOR and SOFR? So I'll maybe answer it also in a simple way. From the look of it, so one is known at the beginning of a period and the other is at the end of a period. Risk-free rates normally are, this is how risk-free rates normally behave. Risk-free rates normally depend on certain past I would say past realization of overnight rates. It's more of a backward-looking rates rather than a more of a forward-looking rates. LIBOR, on the other hand, you know it in the beginning of the period, it applies and it indicates on certain future expectations. And this is not how normally risk-free rates in their pure form behave, or they are. This is not how they are. So this brings up some challenges. So this backward feature is simply knowing interest in advance is definitely convenient, and not knowing that is basically can create certain complication when it comes to budgeting, when it comes to cash management, when it comes to even any risk management functions. Another thing is that any market participants, they should be able to use this rate for discounting and for pricing cash instruments, interest rate derivatives, for contracts that I would say extend for longer tenors. So these are some of the challenges that I would say that someone can immediately think of. And there is one very important challenge is basically the part where we're saying here the lack of bank credit risk premium. So reluctancy to transition to SOFR has been attributed in part to the lack of bank credit risk premium. What does this mean? This means that many banks do not find SOFR to be representative of their cost of funding. So that's another thing we will elaborate a little bit more as well in this webinar. And also SOFR is the day-to-day SOFR shows more volatilities if we looked at historical data. But yet this, I don't see it a big issue because generally these volatilities even themselves out when we look at the averages of more than one day, they do even themselves out, they do net themselves out, and it becomes more swallowable in terms of volatilities. On the upper side of this slide, you can see some of the SOFR varieties. There is compounded in arrears. This is also, you can only know this at the end. So there is sometimes look back period where it's either 2 days or 5 days. What does this mean? That you will only know the interest 2 days or 5 days before the fixing, and it comes at the end. And it's again, backward looking. So it depends on what was the past realization, the daily past realization of SOFR. There is the weighted average. This is the simple SOFR. There is the day average, which is compounded in advance. This also backward looking because it looks compounded in advance. But however, let's say the 30-day average compounded in advance is basically looking at the previous 30 days. So any movement in the current or in the future markets, let's say the Fed says they will hike, that will not be included or embedded within that because it will just, you will know it in advance, but it actually covers a previous tenor. So these are some of the varieties that are currently there. And this side of things is also evolving. And we will see term SOFR as well that is also relevant to that. But before we go into this, it's important to note that, again, I want to emphasize that SOFR or any risk-free rate in general are fundamentally different from LIBOR. And the chart on the right-hand side just give you an example of that. So the chart on the right demonstrates how both SOFR and LIBOR are different. So in the sense, risk-free rate based on secured rate, i.e. repo rates, can actually move in the opposite direction to unsecured ones like LIBOR, a situation most likely to occur when, let's say, markets are under stress. This was proved true when back-tested under the conditions of the global financial crisis, and as shown in the red area in the chart, in the peak of COVID. And the reason behind that, the forces driving the unsecured rates, the LIBOR, including credit risk, can pull these rates higher. And the unsecured interbank markets normally tend to freeze in these situations. At the same time, the forces driving secured rates will pull them lower. Why? Because at this time, there is a run normally for collaterals and there is a flight to safety. And that can have this effect where you can see in the red area where LIBOR is moving up in this area in March 20 up to May 20 and so forth have extremely drastically went down. So that shows how they are fundamentally different. Before we end this slide, though, there is something now as there is term SOFR, which is potentially could overcome some of these challenges. So what is term SOFR? In a nutshell, is a forward-looking rate based on transactions in the large and growing SOFR derivative markets, including SOFR futures, SOFR overnight swaps, IOS. So in July 29th, the Alternative Reference Rate Committee formally recommended the CME Group forward-looking SOFR term rates to further support the transition from LIBOR. So term SOFR will look like LIBOR, it will be known in advance, and it will have a term curve and a term period longer than 1 business day. So term SOFR can also be used in derivatives intended to hedge cash products that reference the SOFR term rate. So can we go to the next slide? So SOFR is picking up. And as you can see in the chart below, this is like the monthly volumes coming from swap markets. So as you can see, we have, this is in January, we are talking about 11.1 trillion only for that month. The dark blue is basically LIBOR contracts or volumes. And you can see how tiny the SOFR at the time, relatively, of course, 106 billion of SOFR. But however, that started to pick up. This is around 105 folds of difference between both. But as we move on this year, it was extreme year, and it comes of how changing the way things are being traded when it comes to LIBOR. We saw that this is going down a little bit. LIBOR has been reduced a bit, and SOFR has been picking up. It somehow averages now at around 7 folds between both sizes. But it's still, we expect that this will continue. It's a big transition. It will take time. And also, there are some SOFR alternatives that are also gaining prominence, like the one you can see in the right-hand side, the Bloomberg short-term bank yield, the American exchange. Also, both, a lot of them are basically are compiled as credit-sensitive reference rates that incorporate bank credit spreads. So, and one thing that is noticeable as well is that there is various surveys that are coming and they are mixed. Some are saying something, but what we have seen most of the surveys that the majority still of corporate respondents are still unprepared for this transition. So I think I hand it over to Paco now to discuss the road to transition.
Thank you very much, Faisal. Good afternoon to everybody, to all the attendants. I think Faisal has done a terrific job to describing the technicalities of SOFR and why we are in this situation right now. My part of the presentation is going to be basically about how the process unfolds itself. I think at this stage right now, we are in a very interesting moment in which you all probably have heard as well that it's not only US dollar LIBOR, but it's as well other major currencies, amongst them particularly sterling and Japanese yen, and as well Swiss francs, that are as well undertaking the same process. And interestingly as well, those three currencies I just mentioned are pretty much done with it. So those three currencies are going to be discontinued their LIBORs at the end of this year. And market participants have already mostly agreed the main terms, if not completely transitioned already derivatives and loans into these currencies, into their RFRs, the risk-free rates for each one of them. But let's focus in this presentation in the US dollar specifically, and what we see out there when we've been helping clients transition financing agreements and as well derivatives from LIBOR into the alternatives. So as I just mentioned just a few seconds ago, banks have, during the whole of this 2021, been already engaging with clients, initiating and running the transition processes. We basically have seen two approaches possible in this process. The first one being basically a very active process in which client and bank slash swap counterparty review exposures, agree the amendments to the documentations of financing agreement and as well to hedges, or potentially they decide to terminate or repay those financing agreements as well and those hedges. We're obviously talking about instruments, financial instruments that have a maturity post December 2021. Again, with the US dollar, we still have a bit of time to June 2023, but the regulators have been very adamant, particularly in the US, that they do not want market participants to continue entering into trades post December this year. All new trades should not be linked to US dollar LIBOR, but they should be linked already to one of the alternatives of US dollar LIBOR, preferably, as Faisal mentioned, SOFR in the US. Obviously, there are some clients or there are some financial instruments that potentially they require no action because their fallback provisions currently are drafted in their documentation agreements. They already contemplate certain mechanisms for the transition, or potentially they do not recommend or they do not specify any mechanism whatsoever, but the parties are happy to continue with these fallback clauses for whatever reason. What I just described is related to financing agreements, to loans, but with the derivatives, something similar is happening as well. But we can say that derivatives is probably more standardized or is been relatively easier to come up with a mechanism to do the transition. Basically, is a year ago in October 2020, finalized the 2020 IBOR fallback supplement and protocol, which is basically a document to which the counterparties to derivatives, by adhering this is the protocol, automatically the hedges will be transitioned in a certain way when LIBOR will cease to be published. Those amendments, the protocol, the is the fallback supplement, is already applicable to all trades that have been entered after January 2021 for what we call the legacy trades, i.e. trades that were documented under ISDAs or long form confirmations, but they have not been adhered to this IBOR protocol. Then there will have to be probably a bilateral negotiation between the client and the bank or the swap counterparty. Potentially as well, the swap the client may want to adhere to this IBOR protocol and then apply automatically all the clauses, or the client may prefer that in order to fully match the terms of the underlying financing or loan agreement, it's better to not to adhere, but to go through a bilateral negotiation in which basically it would be amending, the client would be amending the derivative documentation. The last part of this slide is extremely important. As Faisal mentioned, SOFR is lower than LIBOR, and it has to be like that. And it's reasonable to say that it should be like that because SOFR is a risk-free rate, while US dollar LIBOR is not free in the risk. It contains credit risk. We could actually say, following on to Faisal's descriptions, that is like the banking risk of the system banking risk. It's embedded into LIBOR. Now, there's a mechanism to determine what is that difference, what is the compensation that the parties to this pay to each other when the references change from a higher rate with credit risk into a lower rate that has no credit risk. And this is what is called credit spread adjustment or spread adjustment in the parlance. You can see here the values of the spread, the amount in basis points, roughly 11, 26, 43, 72, that will have to be added to SOFR in any transition. This basically means what you probably are getting, that changing from US dollar LIBOR to SOFR will mean that the interest expense will increase in this amount. Well, technically not, but this is going to be the spread that will have to be added into whatever SOFR is and is being fixed on an instrument in a loan financing agreement or in a derivative in order to pay interest under the new reference. If we consider that currently 3-month US dollar LIBOR is around 16.4 basis points, and SOFR is around 5 basis points. So the difference being roughly 11 basis points. If we look at the 3-month value here, 26 basis points, yes, the reality is that transitioning from US dollar LIBOR 3 months into SOFR plus 0.20 basis points, that will mean that interest expense are increasing for any borrower or any entity that is financing themselves a 3-month US dollar LIBOR and will have to change into SOFR. Just one thing that has to be very, very clear from all this presentation. We're mostly dealing with financial instruments that need to be transitioned, i.e., they are currently outstanding, they will be alive after the end of December 2021, and as well after June 2023 in most of the cases as well. And the reference rate has to be changed from dollar LIBOR into SOFR. For any new transaction, you will not be seeing these credit spread adjustments. You will not be seeing in the reference definition rates SOFR plus 26 or plus 43. But it's reasonable to expect that any lender, any financing party will certainly try to increase credit margins to contemplate somehow the degree of credit risk that now will not be observable under SOFR, but it was before observable under 3-month US dollar LIBOR. As well, point out that this credit spread adjustment right now, these values that we're showing here, this is fixed. It's not subject to volatility, it's not subject to variation. This is basically being calculated as it was agreed as a mechanism for transition back on the 5th of March 2021, when ISDA and with Bloomberg published these values as what is called the historical credit adjustment spread. It's basically the median of the previous 5 years of the differences between US dollar LIBOR, let's say 3 months, or in this slide, 1 month, 3 months, 6 months, and 12, and SOFR compounded for the same type of periods. And it was fixed and it was established. So that shows a very important conclusion, which is that if you're going to transition if you're going to transition legacy, existing loans, financing agreements, hedges, other type of instruments that are linked to US dollar 3 months, you're going to be using by, let's say, default or as one of the alternatives, a credit spread adjustment that was fixed back in March 2021. So this is something that is important because potentially the market may be in a different place now or in the next few months when you undertake your transition. And that different place may mean that you may be better off by doing a transition at the market rate of the difference between US dollar LIBOR and SOFR, as opposed to relying on these spread adjustments that were fixed back in 2021 in March early this year. Can we move into the next slide, please? Before we undertake this slide, we have another question that we want to put out to you, basically relevant to all of you that you replied that you had a US dollar exposure. Can we see the question, please? If you have US dollar exposures, how advanced are you in your LIBOR transition process? You have not started, you have it in mind in your radar. You have just started to analyze and understand the implications. You have already started to undertake negotiations with the parties to do the necessary amendments. You've done it already, maybe. Or obviously, if you don't have exposure, please note. We'll give you 30 seconds and then we see what the answers are.
Thank you very much, Paco. Paco, your voice sometimes goes out. If you can just adjust maybe the mic.
Okay, thank you for pointing out. I'll try to. So let's see the results of that poll very quickly. Okay, so it's probably a mixed bag. I would say is roughly same percentages of not started, but you're aware of that. You have started to do some work, and you're already starting to negotiate with the parties. Yeah, I think it's good to see that people are starting to take notice of this, and I think the main event here is going to be after the end of 2021. There should not be any new product based on US dollar LIBOR. It's true though that in the US dollar LIBOR realm, there's still a good almost couple of years, right? A year and a half to get this issue sorted. But the experience, as we will see later, show us that the earliest that you start to work on it, the earliest you will understand what the potential transfers of value may occur and may happen. And those are the points that treasurers, the FDs, CFOs need to understand, potentially involve someone to help them to make the right decision, which eventually is going to be when do we transition, with which reference rate, and how do we agree the credit spread adjustment with our counterparty. Okay, we can close this LIBOR transition, the poll result, then we can go on to the next slide. Effectively, all of you that have replied that you are already working on it will probably be in one of these stages or have thought about all these stages in their process. We're not saying anything new. We think this is very reasonable. You need to understand your exposure to US dollar LIBOR. That's the first and foremost. Identify which alternative reference rates can be used and could be more convenient to use. Ensure that you are ready for the transition, and then obviously document everything that you are doing and what you're going to agree with your counterparties. Let's go step by step. Understanding your exposure. In this presentation, which is the core as well of both IHATA and Vedanta, we only focus on financial instruments in financing agreements and as well hedges, but we see that many other contracts and agreements in a company can be subject to US dollar LIBOR. For instance, penalties, negotiations. For instance, as well, asset finance as well. There's an issue there as well with the backward-looking rates in LIBOR that still has to be sorted out. There are many other different types of instruments within a company that are as well referenced to LIBOR. But when it comes to financing, we see, for instance, that there is a significant difference between whether the loan is bilateral or is syndicated, and that will determine what's the role as well of the lead arranger. Lead arranger may take different roles in a syndicated loan, and that may make a transition easier or more difficult, maybe more time consuming, because the lead arranger needs to put all the lenders, all the financing parties in agreement. Above all, you certainly need to analyze whether the current fallback provisions in your contracts contemplate the permanent cessation or not. I would say that most of them, if not all of them, contemplate temporary cessation. What could happen if US dollar LIBOR was not published for a certain period of time? But not many of them, if any at all, was contemplated a few years ago, the potential cease of LIBOR being published. If you have an agreement, financing agreement, maybe in the last year and a half, it's more likely that there is some kind of mechanism already built in to incorporate the LIBOR transition. But still, there's a very important point, which Faisal mentioned about SOFR term rates. What we see is that 1-2 years ago, there wasn't a clear expectation of having available SOFR term rates. You want to make sure in your fallback provisions that are flexible enough and you can incorporate now SOFR term rates, because certainly they're going to be very useful. Again, are you free in all your provisions in your financing agreements to agree with the financier, or do you need other parties to agree to whatever change you will do to your financing or to your hedges, that may involve more time negotiating, explaining to different stakeholders what you're about to do. Well, importantly, the facility, if it is maybe multi-currency, you're going to have like a two-stage process, which is basically that, as I mentioned before, sterling, yen, Swiss francs, they are transitioning this year, but US dollar is transitioning or is ceasing to be published in 2023. Are you going to modify or are you going to amend the agreement in just one go, or are you just doing it in stages? Certainly, it would be very efficient to do it in just one go, but potentially there may be some things that you are not able to agree internally or you are not happy with, potentially with one of the currencies. Very important as well, hedging considerations, right? You have an ISDA in place that governs the derivatives that you put in place with swap counterparties. You can easily transition those hedges if you adhere the LIBOR protocol. But as well, you have to be sure that you are going to transition both loan and hedges at the same time. Certainly, this whole process means that there will be some cost, some legal fees to review the contract, some advisory fees as well. Usually what we're seeing is the bank swap counterparties, they're not charging clients for it. They are assuming the whole cost. Certainly they have a significant cost because they need to employ as well legal firms. And as well, be very, very intentional as well in understanding what can be the accounting considerations under IFRS 9, under local GAAP, under US GAAP. There are different questions, different issues that need to be responded. They need to be analyzed before you do the transition, just to make sure that a transition doesn't trigger, for instance, a designation of hedge accounting. When it comes to identifying what is the new reference to be used, you want to understand very well how it is calculated and what's the impact in the business. As Faisal mentioned, the risk-free rates SOFR is a backward rate. You're not going to know how much you're going to pay on your interest if you reference to SOFR on a daily basis until the end of the 3-month period or the 6-month period, whatever is the interest period you are paying. As well, understand the difference between the different alternatives. Even as well, understand if potentially could be now a good moment to taking advantage of this transition, convert your financing into a fixed, and understand how the credit adjustment spread is going to be calculated, is going to be as well agreed. The easy way is what we saw in the previous slide, which is basically it's already been fixed. But you may be leaving money on the table. You may be applied a larger spread if the market spread is lower, or if other reference rates have a lower credit adjustment spread. Then all will drive you into as well analyzing whether your treasury management systems can cope with the new reference. As far as we know, most vendors, if not all of them, they've had enough time to prepare for this transition, and they are all in a manner, in one way or another, they are all now have implemented the new reference rate. But if for any reason you are not ready in terms of systems, or you are not ready to identify the rates, to agree the amendments, then you can always agree a switch mechanism in which basically you continue having US dollar LIBOR until June 23. Next slide, please. Right. So the replacement process is relatively easy, as we financing agreements. It will depend on the fallbacks. Look at the Loan Market Association drafts as well for syndicated loans. It's basically a question of agreeing the spread adjustment. And we have, as we mentioned, two approaches, historical versus forward. And when it comes to derivatives, it's just by adhering to the LIBOR protocol or engaging in bilateral negotiation. For US dollars, you've got to focus on the ARRC. That's basically the main stakeholder of the whole discussion. We have already the fallback supplements and protocols that took effect early this year. And since July, we have a term SOFR that can be used both for hedges and for loans. Really, the main upcoming events is basically 31st of December 2021, when new products should not be done with LIBOR, and then afterwards 30th of June 2020. Can we go into the next slide, please? The five main questions that we see that needs to be asked to the lenders basically have to deal with the issues we've already highlighted. Whether the existing fallback provisions can contemplate this transition. We usually see that's not the case. Fallback provisions usually refer to cost of funds of the bank, or maybe as well to prime rates or to other rates. As well, understand very well the conventions in SOFR and other rates. Whether there is a LIBOR floor as well, that's important. The lender will want to have as well a floor as well on the new SOFR facility. The spread adjustments, how is it going to be calculated, and whether it's possible to apply SOFR terms. Can we go into the next slide, please? In general terms, we've already highlighted the main issues. SOFR is an overnight daily rate. There could be a mismatch in risk-free rate between facilities and derivatives. You've got to make sure that both of them match. The spread adjustment can be calculated based on the median of 5 years or forward in the market price at that time. Transition date as well. You can agree to transition before June 2023, or you can transition on June 2023 and using spread adjustment fixing. With bilateral facilities, it will really depend on the fallbacks, and existence of floors may complicate the calculations. With syndicated facilities as well, you want to understand what's the role of the agent and the lead arranger. For derivatives, as we mentioned, potentially the easy way just to adhere to the LIBOR protocol or undertake a bilateral negotiation to amend the floating rate option definition or reference, and as well whether it's going to be historical or the forward. Again, just to reiterate, you will need to change your valuation models. Banks will need as well to change their valuation models that they use to provide valuations to their clients for accounting purposes, and that could have some impact on hedge accounting effectiveness. Can we move on to the next slide, please? Banks have already been providing alternative rates within their proposals, mechanisms to determine spread adjustments, and possible transition dates. If not, you need to ask them. Then analyze, seek advice on the different alternatives. And we always recommend not only legal, but as well technical, market, commercial, as well undertake the amendment negotiation and sign it off. Be very clear about the transition date, when the existing facility will start being on LIBOR and then changes to the new rate. And once the facility is transitioned, you should check as well the rates that are being fixed. Our experience so far is that there is a significant difference in range of where different banks or different financiers are along this journey. Not all of them offer all the possible alternatives. They are not flexible enough in some cases with regards to dates for transition and as well methodologies to calculate the spread adjustment. And this could make that there could be some unintended value transfers between the client and the bank. And as well, in many cases, they are not well coordinating in offering a unique solution, combined loan plus hedge. Can we go into the final slide of this portion? So our recommendation is certainly to be proactive. Bilateral facilities is probably going to be easier to transition than syndicated ones. Be careful as well with the conventions, 2 versus 5 business days, restructuring charges banks may want to apply. Try to do as well your savings and cost analysis of transitioning now, pre-cessation, before waiting to June 2023. Be careful as well when there could be some value transfers like 0% floors. Be careful as well with different tenors, rate adjustment spreads. And make sure that you understand what's the impact as well on the different rates on the hedging. And with this, I finish my portion. Faisal, you illustrate on the local market implications.
Yes, thank you very much, Paco. Sure. Okay, so for the local market implication, which is the final section in our webinar today, basically, shall we go to the next slide? So from a corporate perspective, exposures to LIBOR can be either by borrowers who are here, I'm talking locally, who has funding arrangement in US dollar, or they are hedging Saudi Riyal funding via US dollar hedges. So for the first one, similar to what have been said by Paco, local corporate borrowers need to be proactive and negotiate the alternative reference rate that would suit their business. Moreover, the new amendments to relevant loans or derivatives documentation should not include any additional features that were not part of the original facility documents. This is very important. Or any trade term sheets if it's derivative, unless compensated for it. We always say accepting what is offered by the banks at face value is not the recommended approach. Based on our experience so far, the communication from local banks is still lagging, and a lot of clients we have came across are still unsure about what happens next and would require more clarity around their US dollar credit facilities. As for the hedging part, which is our main area of coverage, we believe the number and size of US dollar hedges locally is to some extent significant. And the problem with that is basically hedge effectiveness, pricing, valuation, all post the transition. So before that, allow me to take one step back. Why US dollar hedges are being used in the first place? So in Saudi, US dollars are being basically used because they are a mean to reduce the US dollar Saudi Riyal premium spread. On the left-hand side, you can see how the spreads across the 1 year up to 10-year swaps. So when we're talking about these privatization projects, we're talking about project finance that extends for long-term financing arrangements. So sometimes we get to see clients who are seeking to reduce the premium. We're talking about it's not a simple premium, or sometimes for the 3 years it's like 79 basis point, for the 5 years 86 basis point, and here you go. So with that, sometimes clients tend to go for US dollar hedges instead of Saudi Riyal. Also, we see some clients who are trying to achieve longer hedge tenors because the US dollar is a very deep market. So you can go up to 20 years and even more. When it comes to Saudi Riyal, it's up until the 10-year point and liquidity starts to be shallow. So if achieving also longer hedge tenors, sometimes we tend to see clients going for long-term projects with the US dollar hedges. Furthermore, cutting on the hedging liquidity cost. As you can see on the right-hand side, how the bid-offer spread. What is a bid-offer spread? This is the cost of somehow closing your position. This is a cost that your hedge provider is actually taking, and it will pass it up to you. So this hedge bid-offer spread, that is the market liquidity, you can see how far the Saudi Riyal, this is in basis points. So in 2013, we were talking about 15 basis points for the 10-year swap. And in 2021, it's improved. It became around 8 basis points. And this is very much linked, by the way, to the Saudi government indebtedness. So as the debt is increasing, because basically this is building up the curve in Saudi, and with the debt, the longer tenors are having more liquidities and the curve is being built. So that has improved somehow the bid offer spread. But still, if you compared it to the dollar, it's still far away. So this is another reason why we have seen these hedges. Can we go to the next slide? So, of course, the other main reason for that is that there is these, we call them proxy hedges. You are having a dollar Riyal funding and you are hedging it via dollar. It's being done because of this presumed correlation between both references, that both references actually move together. But the reality is that returns on these rates are highly volatile. Looking at the chart, you can see that since 2014, there is not that reliable correlation between LIBOR and SAIBOR. In fact, in some instances, they are negative, like in early 2016, when oil prices dropped and there was some local liquidity pressure, you can see a negative correlation between them. So hedging Saudi Riyal via USD is something we have always advised our clients against unless it is necessary. Now, going back to the context of this webinar, so if Now we say that given that LIBOR and CYBOR are relatively similar in structure, so they are both credit sensitive, they are both unsecured funding rates, extracted somehow the same way, and we get to see these differences. Now, what about if a new reference rate that is going to behave more like a risk-free rate would come here in place? This would make the proxy hedges even more unpredictable for local users who uses US dollar hedges. Next, final slide. Okay, so in this slide, we want to shed some light on the CYBOR situation. So CYBOR is the main interest rate benchmark representing unsecured interbank lending. The vast majority of interbank transactions are up to around 3 months. As mentioned previously, the way of which CYBOR methodology works is very similar to LIBOR via the input of panel banks. It also takes into account local liquidity factors, the US dollar yield curve, given the Saudi Riyal is pegged to the dollar, and the US dollar Saudi Riyal swap points. So it could be prone to the same issues faced by LIBOR, and it could be also, there is a chance that one day the CYBOR would go the path that is LIBOR it's actually going to. For the current at present where we are sitting right now, I'm just going to see this one of the reports on the Financial Stability Board reports. When you go ahead and look at that report, you would find that there are working groups that has been established with the banking sector to deal with this transition implication. This is the LIBOR exposure itself. Also, there is efforts being put to enhance the CYBOR as it stands currently, as with its current structure, via the adoption of waterfall methodology, giving higher priority to actual transactions in the underlying market. This is more of a 3-level system that looks at the bank cost funding via different channels, repo transaction, but however, also in its final level has an element of expert judgment. Because it's very important to note that to support the production of a local risk-free rate, to have here in Saudi a local risk-free rate, there need to be a robust repo secondary market that need to be developed. So this is something we understand is currently in play with the Saudi exchange, with the Saudi Stock Exchange Tadawul. So these are all forming up. So it is basically what we see right now is more around the enhancement of the current structure of CYBOR. There is the CYBOR advisory group that has been created as well. So that's certainly what we are seeing right now. When it comes to some of the things here, so one of the questions I'm seeing regarding Islamic finance, and that's a very important question, is because there are Islamic finance implications. So the use of overnight or background looking rates and not being able to calculate the amount payable in advance for a contract or calculation period presents a significant challenge for Islamic finance transaction. So an optimal solution is required in these circumstances. Also, there is a questions in terms of documentation. So documentation also, there might be a subject with here locally, documentation might be subject to change and to include these fallbacks related to IBORs. So this is also, I would say, a logistical documentation impact that might happen to the current documentations and the ISDA. So before we conclude, because I want to give some space to some of the question, expect your lenders to reach out. Banks are now required to increase awareness by explaining the transition process to internal and external stakeholders in order to ensure a full understanding of the transition plan and objectives and goals. This is what they are trying to do. So you can, of course, enhance your understanding as well by going through the vast numbers of resources you can find in the internet. Also, you can seek independent legal and technical advice. This presentation was more about technical advice. We will also be more than happy to assist you as you go through this transition. So always, please don't hesitate to reach us out. I guess with this, we conclude our presentation. We'll be happy to address some of your questions now, and the rest, we will do our best to get back to you post this webinar. Paco, I guess we have 5 minutes. So if you want to take some of the questions you have in mind.
Yes, certainly there was a very interesting question about because SOFR will be known at the end of the loan period, how to manage the pass through the cost. And this is a very relevant thing, particularly when the loans are big. There will be 2 or 5 days delayed between when the rate is known and when it has to be paid. So the look back conventions for SOFR basically mean that a few days before the end of the period, you will know what's the final amount to be paid on a loan. But just think about it. If you have 3 months, 6 months of interest payments, every day the rate will be fixed on the SOFR if you go for SOFR daily, not for term SOFR. And then you could actually say that towards the last few weeks of the period, you pretty much know how much you are going to pay. You cannot change too much because of fixings available. So in any case, it's probably a good point to note that maybe it's interesting to look for potentially some technology solutions or some resources that can provide you with an accurate fixing on a daily basis of software so that you can track it accurately.
Excellent. So we are fighting with time. I'm just going to try to catch some of these questions. We have the rest. We talked about the ISDA. They are subject to change. We have talked about the Islamic side. There are some difficult questions that need to be answered there as well. One question is saying that if I have a term loan with cyber, does the rate will be changed? Will the rate will change to SOFR? So cyber is not transitioning at all. Currently, cyber is not transitioning your loans. The whole the exercise. This is relevant to your exposures in LIBOR, your exposure to US dollars or any other currencies. So cyber is not transitioning. There is no communication around this in terms of transitioning. But we're saying this that the methodology of cyber is somehow relevant to as close to LIBOR, and this is a possibility in the future. Currently, cyber is being enhanced. So anybody, clients with exposure to cyber are not exposed as we stand to any transitioning. Yes, there is somebody saying that no communication is happening. Yes, as I said, no communication is happening by the banks to local entities, and this is an issue. So banks are lagging in terms of their communication with the clients. They should, it is part from what they are mandated to do to increase awareness around this matter. They should come and discuss with you, provide you with options. And it shouldn't be like just one option, just take it or leave it. There should be options. It should be explained to you in a very clear manner. And of course, from your side, it should be the due diligence should be done as well from your side. You should be look at the technical angle of things and the legal angle of things. But this is an area that we see landing. Some banks, they are actually sharing some papers around this matter. Some local banks, we have seen that in order to try to increase the awareness onto this. So I'm seeing if there is a further questions. So yes, one question is regarding the US dollar Saudi Riyal. How's the Saudi Riyal swap points affect cyber? Yes, cyber is basically a function of either the local situation, the local liquidity situation, how much a bank would be actually being able to borrow in a certain time bucket. And there is also, given the dollar and real peg, there is also a big consideration as well to where the yield curve on the US dollar yield curve is and where is it against the Saudi Riyal. So that's also a consideration of that. So this is where normally the banks that normally submit cyber on a daily basis, these are two factors that are important in the composition of cyber. Yes, there are some other questions. Yeah.
Sorry, Faisal. I just saw there's one question about the overall impact on the accounting treatment. So obviously, if you transition the loan or the financing agreement and the hedge, and they do not have exactly the same terms and are not transitioned at the same time, it could be some ineffectiveness if there is hedge accounting. So these are the things that you need to consider. And in some cases, we're seeing the drive, the discussion and the negotiation IHATA, and that links as well to another of the questions, can can help you understand this point.
Okay, thank you very much, Paco. We don't want to take much of your time. We have booked you for 1 hour on this one. So IHATA is also providing training and consultancy to organization here in KSA when it comes to this, for whoever wants to take this further and understand this transition and its implication. We thank you very much for sparing the time and joining us today. IHATA will continue to provide webinars around important areas of financial risk management and hot topics that are relevant. Until we meet again, thank you very much, and we wish you all the best.